Right now, as you're watching this, something unprecedented is happening in the precious metals market. And if you don't understand what's unfolding before the weekend closes, you could miss the most significant wealth protection opportunity in decades. Let me be direct with you. The silver market just hit $62 per ounce. Gold is holding near record highs. And the people who understand what's really happening aren't celebrating. They're quietly, urgently taking action. Because what looks like a simple price rally is actually something far more serious. It's a supply crisis that's been building for years, and it's finally reaching a breaking point. Here's what most people don't realize. When you see silver prices surge like this, your first instinct might be to think you've missed it, that the smart money already got in, and now it's too late. But that's not what the data is telling us. In fact, the data is screaming the opposite. This isn't the end of a move. It's the beginning of something much larger, and the weekend represents a critical decision point. Let me explain why timing matters so much right now. The physical precious metals market operates differently than stocks or bonds. When markets close for the weekend, the ability to secure physical metal at current prices essentially freezes. Dealers lock in their inventory, premiums adjust, and when markets reopen, everything can look completely different. We've seen this pattern play out before, but never with the underlying fundamentals we're seeing today. The supply situation in silver is unlike anything we've witnessed in modern markets. Retail investors are taking delivery of physical silver at rates that are breaking records. Not just buying paper contracts or ETF shares, actually taking possession of the metal itself. They're pulling supply out of the market permanently. And when you combine that with industrial demand that continues to surge, you get a mathematical problem that has no easy solution. Think about what's happening in the solar industry alone. Every solar panel requires silver. The green energy transition that governments worldwide are pushing isn't optional. It's mandated policy. Electric vehicles need silver. 5G infrastructure needs silver. The artificial intelligence boom that's driving data center construction? Those facilities are massive consumers of silver. This isn't speculative demand that might materialize someday. This is happening right now, and it's accelerating. But here's where it gets really interesting. The mining industry can't keep up. Silver production has been declining even as demand explodes. Why? Because most silver comes as a byproduct of other mining operations: copper, lead, zinc. When those base metal prices don't justify increased production, silver supply doesn't increase either. You can't just flip a switch and produce more silver. New mines take years to develop, billions in capital investment, and we're already behind. Now layer on top of that what central banks are doing. They're not buying silver in massive quantities. That's not their game. But gold? Central banks added more gold to their reserves in recent years than at any time since the 1970s. China, Russia, India, Turkey, Poland, countries around the world are converting dollar reserves into physical gold. They're not doing this because they think gold might go up a little. They're doing this because they're preparing for a fundamental shift in the global monetary system. Let me tell you a story that perfectly illustrates what's happening. Back in 1971, when President Nixon closed the gold window and ended dollar convertibility to gold, most people didn't understand the significance. It seemed like an arcane policy change that only economists cared about, but what followed was a decade of monetary chaos. Gold went from $35 an ounce to $850. Silver went from $1.50 to $50. People who understood what was happening and positioned themselves accordingly didn't just preserve their wealth. They multiplied it many times over. The people who missed that opportunity had one thing in common. They waited. They thought they had time. They believed the government would fix the problems before things got serious, and by the time they realized what was happening, prices had already moved dramatically, and physical metal was difficult to obtain at any price. We're seeing echoes of that period right now, but with some crucial differences that make the current situation potentially more severe. In the 1970s, the world wasn't running massive fiscal deficits across virtually every major economy simultaneously. Global debt wasn't measured in the hundreds of trillions, and the financial system wasn't as interconnected and fragile as it is today. Look at what's happening with liquidity in the financial system. The Federal Reserve recently pivoted to what some analysts are calling QE light. Not full quantitative easing, but definitely not the tight monetary policy they were promising. Why? because the system can't handle higher interest rates without breaking something. We saw that with the regional banking crisis. We're seeing it in commercial real estate. We're seeing it in government debt service costs that are spiraling out of control. When the Fed has to choose between fighting inflation and preventing financial system collapse, history shows us which one they choose every single time. They'll sacrifice the currency to save the system. And when that happens, hard assets, particularly precious metals, become the only reliable store of value. Here's something most people don't know about the COMEX, the major exchange where silver futures trade. The amount of paper silver contracts outstanding dwarfs the amount of physical silver actually available for delivery. It's a fractional reserve system, just like banking. It works fine as long as most people are content to trade paper claims. But when people start demanding physical delivery, the whole structure becomes unstable. And that's exactly what's happening right now. The ratio of paper claims to physical metal has been shrinking. Warehouse inventories are declining. Delivery demands are increasing. It's a slow-motion squeeze that most people aren't paying attention to because it's not making headlines. But the people who understand commodity markets are watching this very carefully, and they're acting accordingly. Let me give you some specific numbers that illustrate the severity of the situation. The silver market runs a structural deficit, meaning demand exceeds supply, of roughly 200 million ounces annually. That deficit has to be filled from somewhere. Initially, it comes from above-ground inventories. But those inventories aren't infinite. At current deficit rates, we're drawing down stockpiles that took decades to accumulate. What happens when those stockpiles run low? Basic economics tells us that prices have to rise until demand is destroyed or new supply is incentivized. But here's the problem. Much of silver's demand is industrial and price inelastic. A solar panel manufacturer can't just decide to use less silver because the price went up. The panel won't work. An electronics company can't eliminate silver from circuit boards. The technology requires it. So if demand can't easily decline and supply can't quickly increase, the only variable that can adjust is price. And it has to adjust enough to ration the available supply among competing uses. Some analysts believe that equilibrium price could be substantially higher than current levels, potentially multiples of where we are today. Now, I want to take a brief moment here because this is relevant to many of you watching. If you're sitting on retirement accounts, IRAs, 401ks with $100,000 or more, there's something you should understand about how gold IRAs work. I put together a comprehensive guide that covers how you can get physical precious metals into your retirement account without triggering tax penalties or early withdrawal consequences. It's in the description below. It walks through the process, the rules, the custodians who handle this, and what you need to know. If that's relevant to your situation, it's worth checking out. All right, back to what's happening in the market right now and why the weekend matters so much. When we look at historical precedents for supply squeezes in commodity markets, we see a consistent pattern. The squeeze builds slowly, then accelerates rapidly. Prices can remain relatively stable for extended periods while the underlying imbalance grows. Then, seemingly suddenly, prices gap higher as the market reprices to reflect the true supply-demand situation. We saw this in palladium a few years ago. We saw it in uranium more recently. We're seeing it in copper right now as the electrification trend accelerates. And the setup in silver looks remarkably similar, except the supply-demand imbalance is arguably more severe and the industrial applications are more critical. Think about the geopolitical dimension of this as well. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to reduce dependence on the dollar for international trade. They're not doing this because they dislike America. They're doing it because they've watched how financial sanctions have been weaponized, and they want alternatives. Gold becomes crucial in that scenario because it's the one asset that every country recognizes as valuable, regardless of political relationships. When countries start settling trade in currencies other than dollars, or using gold as a settlement mechanism, it reduces global demand for dollars. And when demand for dollars declines while the supply of dollars continues to increase through deficit spending, the value of each dollar has to decline. That's not a political statement, it's mathematics. For individuals, this creates a serious problem. Your savings, your retirement accounts, your purchasing power, all of it is denominated in dollars. If the dollar's value erodes, your wealth erodes with it, even if the nominal number in your account stays the same. This is why precious metals have historically served as wealth insurance. They maintain purchasing power across currency devaluations because their value isn't dependent on any government's fiscal responsibility. Let me share another historical parallel that's instructive. In 2008, during the financial crisis, gold initially declined, along with everything else as investors scrambled for cash. But within months, as the Fed's response became clear, massive money printing, zero interest rates, quantitative easing, gold began a sustained rally that took it from around $800 to over $1,900 by 2011. The people who bought during the initial panic, when everyone else was selling, positioned themselves for extraordinary gains. We might be in a similar moment right now. The financial system is showing stress signals. The Fed is pivoting back toward accommodation. Fiscal deficits are exploding, and precious metals are beginning to reflect these realities. The question is whether you recognize the pattern and act accordingly, or whether you wait until the move is obvious to everyone and prices have already adjusted. Here's what makes the current weekend particularly significant. We're heading into a period where market dynamics could shift rapidly. Year-end positioning by institutional investors, potential policy announcements, geopolitical developments that could emerge at any time. The precious metals market is relatively small compared to stocks or bonds. It doesn't take massive capital flows to move prices significantly. And when prices start moving in a supply-constrained market, the moves can be dramatic. Consider what happened in the nickel market in 2022. A short squeeze on the London Metal Exchange caused prices to more than double in a matter of days. Trading had to be halted. Contracts were canceled. It was chaos. Now, I'm not predicting that exact scenario for silver or gold, but I'm illustrating how quickly things can change when supply-demand imbalances meet market structure vulnerabilities. The smart money isn't waiting to see what happens. They're acting now, while physical metal is still readily available at prices that reflect current market conditions. Because they understand that in a supply squeeze, availability becomes just as important as price. You can't buy what isn't for sale, regardless of how much you're willing to pay. Let's talk about what acting actually means in this context. For most people, it means allocating a portion of their portfolio to physical precious metals, not paper proxies, not mining stocks, but actual metal that you own and control. The traditional recommendation has been 5 to 10% of a portfolio in precious metals as insurance. But given current conditions, some advisors are suggesting higher allocations might be appropriate. The key is to think of this not as speculation, but as wealth preservation. You're not trying to get rich quick. You're protecting purchasing power against monetary debasement and financial system instability. If gold and silver prices don't move dramatically higher, you still own valuable assets that have maintained their worth for thousands of years. But if the scenarios we've been discussing play out, that allocation could be the difference between preserving your wealth and watching it erode. There's also a psychological element to this that's worth understanding. When you own physical precious metals, you have an asset that exists outside the financial system. It's not someone else's liability. It doesn't depend on a bank's solvency or a government's promises. In times of uncertainty, that peace of mind has real value. You can sleep better knowing that part of your wealth is protected regardless of what happens in markets or the economy. Now, some people will argue that precious metals don't generate income like stocks or bonds. That's true. But that's also missing the point. Insurance doesn't generate income either, but you still buy it. Precious metals are financial insurance. And right now, given the risks in the system, that insurance is arguably underpriced relative to the protection it provides. Let me address another common objection. People say, but the government could confiscate gold like they did in 1933. First, that was a very different era with different monetary systems and different legal frameworks. Second, even if you believe that's a risk, it doesn't apply to silver, which has never been confiscated. Third, and most importantly, the alternative, holding only paper assets in a system that's showing serious stress, carries its own risks that might be far more likely to materialize. The reality is that every financial decision involves trade-offs and risks. The question isn't whether precious metals are perfect. Nothing is. The question is whether they improve your overall risk profile given current conditions. And for most people, the answer is yes. Here's something else to consider. The precious metals market is global. If supply tightness develops in one region, it affects prices everywhere. We're already seeing premiums, the amount above spot price that dealers charge for physical metal, increasing in certain markets. That's an early warning sign that physical availability is becoming constrained. When premiums rise, it means demand for physical metal is outstripping supply at current prices. This is why the weekend matters. Dealers adjust their premiums based on market conditions and their inventory levels. If significant developments occur over the weekend, geopolitical events, policy announcements, market moves in Asia, premiums could adjust higher before U.S. markets reopen. By acting now, you lock in current pricing and availability. Let's also talk about the difference between paper and physical precious metals. ETFs and futures contracts serve a purpose for traders and investors who want price exposure without the logistics of storing physical metal. But they're not the same thing as ownership. In a real crisis, when you most need the protection that precious metals provide, paper claims might not be as reliable as physical possession. We've seen this play out in other markets. During the 2008 crisis, some ETFs had to suspend redemptions. Some funds couldn't deliver physical metal to investors who wanted to convert their shares. The fine print in these products often contains clauses that allow for cash settlement instead of physical delivery. If you're holding precious metals as insurance against system stress, you want to make sure your insurance will actually pay out when you need it. This doesn't mean paper products have no place. They can be useful for trading and speculation. But for the core wealth protection allocation, physical metal that you own and control is the gold standard, if you'll pardon the pun. Now let's zoom out and look at the bigger picture of where we are in the economic cycle. We're in an environment of massive debt, aging demographics in developed countries, and political pressures for increased government spending. That's a recipe for continued monetary expansion regardless of which party is in power or what central bankers say publicly. The math simply doesn't work otherwise. When you have debt levels that exceed GDP and interest costs that consume an ever larger share of government budgets, there are only a few ways out. You can grow your way out, but that requires sustained high growth rates that seem unlikely given demographic trends. You can cut spending dramatically, but that's politically difficult and economically painful. Or you can inflate your way out by devaluing the currency, which reduces the real burden of debt, but also reduces the real value of everyone's savings. History shows us which option governments typically choose. It's not the painful one. It's the one that spreads the cost across all currency holders through inflation. And that's why hard assets become so important in this environment. They can't be inflated away. Their value adjusts to reflect the changing purchasing power of the currency. Some people look at current inflation rates and think the problem is solved. But inflation isn't just about consumer prices. It's about the expansion of the money supply and the debasement of the currency. Even if consumer price inflation moderates temporarily, the underlying monetary dynamics continue, and those dynamics are what drive precious metals prices over the long term. Consider what's happened to the money supply over the past few years. The expansion has been unprecedented. Yes, some of that has been pulled back, but we're still operating at levels that would have been unimaginable a decade ago. And with deficit spending continuing at elevated levels, the money supply will need to expand further to accommodate that debt issuance. This is the environment where precious metals shine. Not because they're going to make you rich overnight, but because they maintain their value while paper currencies lose purchasing power. An ounce of gold today buys roughly the same amount of goods and services that an ounce of gold bought a century ago. Can you say the same about a dollar, about any fiat currency? The weekend represents a decision point. You can act now, while physical metal is available and prices reflect current market conditions. Or you can wait and see what develops, accepting the risk that conditions could change rapidly and unfavorably. Neither choice is wrong. It depends on your risk tolerance and your assessment of the situation. But it is a choice. And not deciding is itself a decision to maintain your current positioning. Let me be clear about something. I'm not suggesting you liquidate everything and go all in on precious metals. That would be just as foolish as having no precious metals exposure at all. What I'm suggesting is that given current conditions, the supply dynamics, the monetary environment, The geopolitical tensions, the financial system vulnerabilities, a meaningful allocation to physical precious metals makes sense as part of a diversified wealth protection strategy. The people who will look back on this period with regret aren't the ones who acted and were wrong. Markets go up and down, and timing is never perfect. The people who will have regrets are the ones who understood what was happening, recognized the risks, but failed to act because they were waiting for more certainty or a better entry point. In markets, certainty comes at a price, usually a much higher one. Think about your own situation. What percentage of your wealth is protected against currency debasement, against financial system instability, against the scenarios we've been discussing? If the answer is 0 or close to it, you're taking a position whether you realize it or not. You're betting that the current system remains stable, that monetary policy remains sound, that the debt situation resolves favorably. Maybe that bet pays off, but what if it doesn't? The beauty of precious metals as insurance is that you don't need to be right about the timing. You just need to be right about the direction. And the direction, toward more monetary expansion, more debt, more currency debasement, seems pretty clear based on the incentives and constraints facing policymakers. This weekend, while markets are closed, and you have time to think clearly without the noise of daily price movements, is an opportunity to assess your positioning. To ask yourself whether your wealth protection strategy matches the risks you face. To consider whether the insurance you have is adequate for the environment we're in. The precious metals market will be here on Monday. Prices might be higher, they might be lower. But the underlying fundamentals, the supply constraints, the monetary dynamics, the geopolitical shifts, those aren't changing. They're intensifying. And at some point, prices will adjust to reflect those realities in a way that's obvious to everyone. The question is whether you position yourself before that adjustment or after it. I want to leave you with one final thought. Wealth preservation isn't about being the smartest person in the room or timing markets perfectly. It's about recognizing risks and taking reasonable steps to protect against them. It's about not letting the perfect be the enemy of the good. It's about acting when you have the opportunity, rather than wishing you had after that opportunity has passed. The weekend is here. The opportunity is now. The choice is yours. Don't let this moment pass without at least seriously considering whether your current positioning adequately protects you against the scenarios we've discussed. Because once the market reprices to reflect these realities, the opportunity to position yourself at current levels will be gone. And unlike stocks or bonds, when physical precious metals become scarce, you can't just create more supply with a keystroke. The metal either exists or it doesn't. And right now, while it's still available, might be the time to act.